And we're at the top of the hour, and welcome to Horde's Dairyman Livestream. Is the milk rebound for real? Welcome, and I'm your host, Corey Geiger, Managing Editor of Horde's Dairyman. We're broadcasting from our newly created studio in downtown Fort Atkinson at the historic W.D. Horde & Sons Company. Before we begin our discussion, the best analogy I can think of for our dairy markets is a snow globe. And I got one here with a little reindeer in it. But last fall, my family met with the Aurora St. Luke's Advanced Heart Failure and Transplant team in order to discuss options for my father, who has just suffered a major heart attack. And over the 12 hours, we met with 8 different teams at Aurora St. Luke's. It was like drinking from a fire hose. Then the psychologist came in the room. He told us, no way, dude, it's not a fire hose, it's a snow globe. Every time you think you got it figured out, someone comes in, tips it upside down, and shakes the heck out of it, and you can't see through it. All you see are the snowflakes. You're looking almost like you're through a blizzard. And that analogy made a lot of sense. The psychologist was from Michigan's Upper Peninsula, where they get over 100 inches of snow each year. Consider this. In the last 90 days, we've gone from $1 a pound to over $2.80 per pound for cheese. In 90 days, that's unbelievable. And so with that as a prelude, let's go to a poll question. And Jim Baltz, our producer, will put that on the screen. What do you think is the most responsible for the current milk prices? A, reduced milk supply. B, restaurant orders filling up the quote-unquote food pipelines. Or C, USDA's Farmer to Family Food Box program. So go ahead and answer that poll question here. And we're going to look forward to seeing what you think is the answer. And we're up to 50% here. If you're watching online, you'll see that poll question pop up. If you're watching and you have your cookies or pop-ups blocked, you might want to change that. And obviously, if you're listening on your cell phone, that might be a little challenge to take our poll question here. So Jim, you can cut that off when you think we're at a good spot. And you see the answers here. It's almost equally split. And with that as a backdrop, we invite the University of Wisconsin's Mark Stevenson to the program. Mark, what's your take?
You know, Corey, I'm about like our pollsters or people answering the questions, that I'm about evenly split too. We've certainly had things that have been impacting milk prices, and in a pretty big way. Milk production. You know, here we were in April, March and April, and we had folks pleading to slow down milk production, tap on the brakes. I was amongst that group. I thought that we couldn't have a demand solution to the problem at that point in time. It was a demand problem. We couldn't find new customers fast enough, and so we really needed to slow down milk production. And we had a number of base excess plans that were put into place, or folks who were simply told, I can't take all the milk, so you have to slow down. And we did. We went from producing something like 625 million pounds of milk per day in March to a little over 608 million pounds per day in May. Now, I will just let people know that we have a seasonality in milk production, but we're usually hitting our peak in the month of May. So to be below milk production from year earlier levels in May from the kind of peak we saw in March is most unusual. In fact, March milk production was up not quite 3, but nearly 3%, pushing that kind of range. Last month's milk production in April was up a little over 1%, and this month we were down about 1% across the country. A lot of variation in states, but most all of the states from Texas to South Dakota into the east were flat to down significantly. In the west, it was a little bit more of a mixed bag. Some states up, some states down. So milk production clearly played a part in all of this. We had reduced milk production, but we also saw some opportunities for new demand. First of all, retail sales continued to be strong, and even for cheese. Maybe we'll get a chance to talk about that a little bit more in the next couple of weeks when we have some additional folks coming on the program. But nevertheless, retail's been good. And then we saw the food box program open up and the government purchasing substantial amounts of dairy products for those food giveaways. That was unquestionably demand, and it was an emotional motivation for people that product was moving. So that was another thing. And then finally, more recently, in the last few weeks, we've seen a number of states opening back up, saying it's okay under certain restrictions and social distancing and other cautions, we can begin to have restaurants and bars reopen. And so those restaurants and bars began to order their supplies and stocks and fill their own pipelines again with product, including dairy. And there was that little bit of surge that went on too. Now, finally, into all of this, go back a couple of months, as you mentioned, we had cheese at $1 a pound. That was significantly less than other exporting countries of the world at that point in time. And at that kind of price, it stimulated some export sales. So we had some quick sales of people coming to the US looking for cheese, and we sold some of that product overseas. The last thing that I think was a motivation in here, we have this seasonality of production and seasonality of demand of dairy products, which are almost counter-cyclical to one another. As I mentioned earlier, we tend to peak milk production in May. We build stocks of relatively storable dairy products like butter and cheese, and then we sell those products more in the fall from Thanksgiving on through not only Christmas, but also Super Bowl. And so that big demand season is a draw when we aren't producing as much milk. And buyers of dairy products will usually sit back and watch and see, are we having a big spring flush? Do we have a lot of product in storage? Is it there and available for us? If so, I'm going to sit back and watch and see what happens to product prices. If they're relatively low, I'm going to stay back and not buy until I think we're at the bottom. Well, when those prices began to move up from purchases, whether they be government or exports or otherwise, those folks got up off the bench and began to purchase products for fall needs as well. And so you had a bunch of demand things happening along with the tightening milk production, and that's given rise to this explosion, unprecedented explosion in price. As you mentioned, well over $2.50 a pound for cheese in our current spot markets, and they've been a little bit up, a little bit down, testing the waters. I don't think it's sustainable, and I hate to sound like the wet blanket here and all of this euphoria we're seeing about prices, but I don't think those prices are sustainable. At $2.70 a pound for cheese, that's fully $1 higher than other export opportunities would be for customers. Oceania prices are now about $1.70 a pound. So this is much higher. We will become a destination for cheese, not a source of it. So I think that those prices will have to get roped back in. We do have futures prices for months here in the coming right up that are looking at $21 for June prices right now for class 3. We're looking at over $22 in July for class 4. What a change. You got to remember that we were talking about $12 and $13 and even $11 prices for these months just a couple of months ago. So there's been a tremendous shift in price opinions over this time period. And now, we see some decay after July in futures markets opinions, but we're still talking about prices in the $16 at the worst, projecting on through 12 months from now. So clearly we're at a time when markets are optimistic. I personally don't think that's going to hold. I think that we're going to have to see some realities back in here. This is all untested waters. COVID has done everything from dragging us down to the bottom and now giving us this elation here. I don't think we're done with volatility. So I think that's about what I can leave you with.
So what you're really saying, this is a pretty fragile high. Would that be correct, Mark?
I think it's a fragile high, but what do I know? I don't make milk myself, and I buy dairy products, but only at retail. So, but I've been an observer of this industry for 40 years. And while this is uncharted territory, I don't think these prices are sustainable. First of all, I would say, if I'm a cheesemaker, I'm going to be pretty nervous about this stuff. Do I want to, in the flush season of the year, make a lot of product with $22 class 3 milk prices and put that away for a month or 2 or 3 when those product prices can fall pretty dramatically and erode the value of my inventory? My working capital has now been shot if that happens. So I think the cheesemakers are going to be pretty hesitant to be paying full price for product.
Well, let's remind our audience here that they can begin to ask questions here. We're going to hear from Chris and then Andy shortly here. But go ahead in the panel here on the GoToWebinar control panel and ask those questions. And now we're going to turn to Cornell's Chris Wolf. Chris, after listening to Mark, it appears that we need to discuss some sensible management strategies in this snow globe world that is constantly shifting with the dairy market winds. Chris, welcome to the program.
Thanks, Corey. Yeah, I think Mark covered it all. I think we're probably done. We can sign off. We did a good job there. But, so if we're thinking about the risk of these high milk prices coming back down, and they will come down at some point, remember how we didn't have volatility for about 5 years there because prices were kind of low and sustained. Well, we're back on the roller coaster, it appears. We got off the tilt-a-whirl, Andy, and we're back on the roller coaster. So, what we're thinking about risk management related activities at the herd level, at the farm level, the risk management kind of things that you do fall into 3 general categories. You either want to reduce the impact of adverse outcomes like dairy RP insurance or hedging or put options, for example, or you want to improve risk bearing capability. So thinking about maintaining your liquidity, financial reserves, production capacity there, or you want to, the third type of risk management activity is maintaining decision-making flexibility. So, like investing in flexible type technologies and giving yourself more flexibility from the production side. So with the risk being related to the milk production, I think there's been, some options there in dairy RP, where Q3 is no longer an option. Q4 today for class 3, $17.15. For class 3, $16.07 for class 4. I noticed that class 3 was down 25 to 40 cents from July through November to start today here. So these markets are really searching because there's just so much uncertainty both on the demand and the supply side, as Mark explained. So what do they do? Well, I think that at the herd level, it depends on at least a couple different factors. One is, what have they done in the last 2 months with their herd management and their production, right? So if you're in a place where there was a base excess program and you cut back milk production, how did you do that? Do you have some flexibility to bring it back? If you made some nutritional changes, how much can you get back out of that? Do you have heifers that you can bring in? Do you want to look at purchasing some more cows? If so, kind of what's the timeline that you can do that over? But then the other thing is, and I tend to focus also on these national prices like class 3 and class 4, but the actual prices that the farmers are going to get paid is going to vary really widely depending on where they're at and where they're marketing their milk and what co-op they're at, what the state and regional situation is. So $21 class 3 milk does not mean that everybody's check is going to say $21. There are still the base excess programs, and I would say, as much as there is risk in the kind of class 3 and class 4 price right now, there's probably an equal amount of basis risk depending on what your co-op, your state, regional, and farm factors are. So that's something that needs to be kind of considered also when you're looking at what your options are there. And I'll pass it back to you, Corey.
Thank you, Chris. Before we introduce our third guest here, we're going to go to a poll question here, and Jim Baltz, our producer at the University of Illinois, will put that on the screen. With these high milk prices, what will you do? You can select one or more of the following. Feed for more milk per cow. Add cows. Hold the line. These prices will not last. Hedge future milk prices. Heck, this is a good time to sell the cows or the farm. So go ahead and answer those poll questions. Again, you can pick more than one here. And these responses will be interesting here as well. We're getting a great response to the question. And as we do that, I'd like to remind our audience that they can ask questions. My colleagues here, Caitlin Allen and Maggie Gillis, will be sorting through those and preparing them for the second half of the program. So Jim, we're over half of votes are in. When you feel comfortable, you can close that poll. And interesting responses, and actually sensible responses, would be my first take. Andy Novakovic, welcome back to the program. What do you make of these markets? And take a look at that poll question there. We got 55% say hold the line, these prices will not last. 54 say hedge their milk. And 23 did say feed for more milk per cow. But the add cows and good time to sell it were under 10%. So Andy?
Yeah, I think that's probably a pretty good reflection of not only national sentiment on the production side, but also on the processing and consumption side. You know, Corey, I got to Cornell before Mark did, but after Mark arrived, and I would get questions about, what's going on in the marketplace and what's going to happen. My first thought, like everyone else in the U.S., was just figure out where Mark was and see if he could give me the answer. But, there were times when Mark wasn't available and I had to kind of wing it. And my instinct was always to try to say, well, okay, before I can even think about, is this going to persist? Is it going to go up? Is it going to go down? I want to try to see if I can figure out how we got to where we are. What were the causal factors? In the first poll, 2/3 of the participants basically identified one of the demand factors. 1/3 identified the supply factors. I thought that's pretty interesting for a group that's probably leaning pretty heavily on the producer side. And I'm not here to say one of those answers was wrong and one was right, because I think, as Mark said, they all factor in there. And I'm not sure I would say one was more important than the other. But what I'd like to do is focus on that demand side and kind of get a little bit into what are the indicators looking forward and how is it that we got to where we are. Mark mentioned some of this, and in fact, we've had previous speakers that have talked about what's going on in markets and demand destruction in food service. Steve Kyle talked about employment and earnings and those factors. If you look at the data that tell us something about the consumption side and where consumers' heads are at, you've got some hard data. What are consumer expenditures? What are employment? What's happening to savings? What's happening to growth in the national economy? There's a little delay in those. We don't know what's really numbers for June, and actually a lot of these data, we don't have hard numbers for May even yet. But we do also have other surveys that are asking consumers how they feel about stuff. Mark likes to use the consumer confidence survey that an organization called the Conference Board puts out. It's usually available on Mark's website. The University of Michigan has a similar one that they call consumer sentiment. And they kind of get at sort of little different angles on this. And what I glean from looking at some of those indicators are that consumers are, when you ask them how you doing now, they give you answers that say, it's kind of looked a little bit tough sledding, but we got some stimulus payments. My employer got the loan from the federal government on paychecks, and that helped. And maybe I was furloughed for a while, but that extra $600 that the CARES Act allocated for unemployment, so actually I didn't do quite so bad. And when you look at today's answer versus the answers of a week or a month ago, this sense of how am I doing now seems to be improving. Now, I should preface that by saying if you asked these same questions a year ago, everybody felt a heck of a lot better about the whole thing a year ago. So we're kind of in the hole looking up, but we're becoming a little bit more optimistic. On the other hand, when you ask consumers to talk about how do you feel about what's coming down the road? How do you feel about the strength of the economy going forward? How do you feel about your own personal position, your family or household position? Then you start to see them being a little bit more cautious. Maybe not down in the dumps pessimistic, but more cautious, not so certain where it's all headed. If you look at what data we have on how the economy and consumer expenditures are going, which is a little bit lagged, it's beginning to look like consumer spending is not really increasing so much as it's reshuffling, which is sort of what the story was 2 months ago. Everybody's eating food, but they're not eating food in the same places. Well, that story is kind of unwinding and going in a different direction now. Food service is up. Grocery shopping in regular grocery stores, flat. That's not really up, down, or sideways. Online shopping is declining when it comes to food or meal kits and that sort of thing. If you look at consumer expenditures beyond the food sector, there's ups and downs. Online on almost every category is down, and going back to physical store buying is up. Things like hobbies and sporting goods aren't really doing much. Home improvement is actually declining, but apparel and personal care, getting your hair cut or styled and all that kind of stuff, that's increasing. Clothing is increasing. So it's not really everything is growing so much as it's just kind of recalibrating as different opportunities present themselves. And I think what this suggests to me is that society in general, while certainly having an amazing array of opinions, in the main is saying, I've just been through the ringer. I think I'm okay now, but I'm not going to get too crazy about going forward. I'm not looking to where I'm going to be spending my next vacation. I'm not going out to eat as much as I maybe could do or have done in the past, because maybe I got a little income concern, maybe I got a little health concern, whatever that might be. And I think this tentativeness on the consumer side puts some constraints on our enthusiasm for how much we can produce and our ability to sell it. It's also the case, Mark mentioned seasonality. I think he was talking primarily on the production side, but as we all well know, there's also a certain amount of seasonality on the consumption side. We're entering kind of the low consumption phase. People don't drink as much beverage milk in the summer months. Ice cream, of course, does well, but ice cream isn't that big a thing. This is not the peak season for cheese or butter or some of those other basic products. Export markets are still looking a little bit uncertain. And as Mark said, we're not selling anything to anybody if our price is twice the price of all the other exporters. So, these sorts of indicators to me are suggesting that we probably can't sustain prices at this height from the buyer's side, never mind what we might see on the seller's side. And so, the word that I've used often is markets, I think, are turbulent, and I think they will continue to be turbulent. And I think for whether you're on the buying side or the selling side, there's going to be, I think, some pretty big incentives to think real seriously about taking a risk management position when prices look favorable for you 3, 4, 6 months down the road.
Well, thank you, Andy. And as this is taking place, the cheese barrels are up a few pennies, but blocks are down some today, and there was quite a bit of spread between them, but trading is still going on in the CME today. It's interesting here. This is the other unique thing, and we're going to go to questions here right now, and the audience has sent in some really good ones here. We're going to start with one, though, that's about as unique as it gets. Class 3 milk, not Class 1, could be the price leader here in the June milk checks. In fact, June's Class 3 milk price, driven by cheese price gains, is expected to be up over $7 per hundredweight, exceeding $19 per hundredweight in June. And that comes from Carrie Hunter, the interim market administrator for the California Federal Order. the Class 1 price, as people know, was announced the first 2 weeks of May, and will not reflect the spike that we had in the cheese markets. So the components prices could be higher, and Class 1 may even be the lowest class price of the month. Now, that's not going to get announced till next week, but some really crazy things are happening out there. Comments and thoughts from the three of you?
Well, I think we can guarantee that we're going to have a pretty large negative PPD in essentially every milk marketing order this coming month. And the reason for that is the classic reason we get negative PPDs anywhere, and that is the timing issue. That anytime we have milk prices rapidly rising, and boy, that's certainly what futures markets are expecting now, and most of us, we can get to a place where we're paying out more in Class 3 components than we are collecting in a weighted average across all classes of milk. And that gives us a negative PPD. By the way, if you ever wondered about that, look at the uniform price, the statistical uniform price, or the blend price as it's called sometime, and subtract the Class 3 price from it, and you will always exactly get the PPD value. And so negative PPDs are really kind of an accounting thing that happens to make the pools balance. And this is going to be a negative one, so be prepared for it. Don't get mad at it. Say, I'll take a negative PPD every day if it means my prices are going up.
And PPD, producer price differential, is a little different than what some people may have been seeing, that dairy farmers may have been seeing in their milk check, of a deduction that was for other reasons. And Andy and Chris, would you talk about that?
Yeah, well, that's an excellent point. And, you know, it's always the case that cooperatives or individual farmers would love to be able to negotiate a higher premium when the market price goes down. It would be a wonderful situation if you could do it. But the market economics that pushes those prices down doesn't really create an environment for asking for a lot of premiums, and vice versa. And so in this current market, we've seen these huge deducts because so much milk is sold at a distressed level, or milk was even being dumped, on top of the fact that we had these low class prices. And then you throw in these base excess programs, so that for some farmers, the overbase price was, you know, $5, $4, $5, $6, $7, $8 less than the base price. And I think the current environment, to me, would suggest you're probably not going to have a low overbase price, because you don't have a lot of distressed milk. The market's saying, give me milk, give me milk. And so we could have, you know, the Class 3 values catapulting the minimum price up at the same time that we see a reduction in these various different forms of co-op deductions. And, you know, that's wonderful news for farmers, don't get me wrong, but it's going to really add to the turbulence of the prices that we see in the mailbox from, you know, April through August.
Yeah, well, I think the big thing is, right, is you're going to see some negative numbers on this milk check, and the federal order part means that the following month it's going to go the other direction. So the good news is it's coming on that part, and then working through on the co-op situation, that's a little bit different, right? So, yeah.
There's quite a few questions coming in here, and I'm trying to knit them together, but I think what we're going to start with here is a little bit more of a setup. Let's go back to the USDA purchasing program here, and you know that's had a pretty big impact on what's going on in the current markets, and how does that play out now in June and the rest of the year, in terms of what USDA will be doing with their food box program? And then we'll come into some of the other questions.
Well, I can take a jump at that, and then Mark can correct me. I think there's two things. One is, what is the magnitude of expenditures? And the second thing is, what is the skill with which those orders are being filled? And, you know, this program, if we're talking about farmers to family food box, was scheduled to go through December. And, you know, a bunch of money was contracted, and a bunch of that money that was contracted early was out there trying to acquire product. But there's still more to come. We didn't spend all the money right away. We haven't bought all the product to fill those bags, whether it's dairy products or fruits and vegetables or whatever. And so there is still money to be spent. And so that's still going to represent some demand. But I think, and this is really anecdotal, I certainly can't say that I've got personal knowledge of all this, but there's a lot of reports suggesting that people that got these contracts really were unfamiliar with product procurement, probably for more than just dairy, and ended up doing it in a clumsy way that probably a more experienced purchaser would not have done, and that added to this, you know, intense stress on buying, particularly fresh cheese. I think there's a whole lot of folks that learn from that experience. There's a number of folks that will not be getting renewals on their contracts. There'll be some new people that will. So I think, yes, we're going to continue to have our foot on the gas pedal, but I think probably the how we do it is going to make some difference in terms of that aspect of spiking demand.
You know, the second part of that here is a question that comes in, and we're going to talk a little bit about the sales side here, and then we'll move on to the farm level here. There's a lot of farm questions coming in too. Does anyone know how much cheese has been committed to export sales and for what duration of time? And Andy used the word anecdotal. You know, this is such a turbulent time. Data, collecting data, what, you know, and USDA and NASA is working hard to get, you know, milk production data and balancing out how many cows are sold and versus what production shifts have been. So, you know, these are very fluid times here, but let's come back to this. Let's talk about cheese exports. And Mark touched about that. You know, if the prices stay that high, that'll be a bit of a challenge, but that plays a role. So the question is, does anyone know how much cheese has been committed to export sales and for what duration?
I think the simple answer to that, Corey, is no, we don't. I mean, it takes time to collect that kind of data and information, and the hard reporting that we get doesn't really happen until the product leaves our shore, until it gets put on a boat. And at that point in time, then we have customs, you know, that's going to say this much left the shore. We have heard anecdotally, you know, about sales that occurred at that $1 a pound cheese kind of price. But again, those are kind of private negotiations that we won't have good information about until the product actually leaves. There's a lot of steps that take place in there, and that can be several months from now. So it will be a while before we understand what the impacts are. But, you know, certainly product was committed to be moved and sold, you know, that a couple months ago when we had those low cheese prices.
I think the most recent government data is still April. And one of the things I would like to throw out there is we always have to be really careful when we hear reports about market activity when they say sales are up. The sales usually means a number that begins with a dollar sign. And when you talk about that kind of measure of sales, part of it's going to be price and part of it's going to be quantity. And, you know, it can go in different directions. And, you know, it's good if sales are up because prices are up, I guess. But I always like to look at the quantity number. And on the quantity side, through April, we've done fairly well with powders, but cheese is down and butter is kind of trivial anyway, but butter was also down a little bit. And you know, we may find in May that, you know, there wasn't a whole lot going on, but with these big price increases, I can't imagine anybody selling something. I think one of the more current indicators that we can all access is if CWT allocates some money to assist in the exports of certain products. That will be an indication, number one, that there's something being sold, and number two, that it needed a hand.
In CWT, as cooperatives working together, they collect about 4 cents per hundredweight to help with dairy exports. So we touched on this a little bit, but a real specific question, and it was a spring flush dampened due to production cutbacks. We do know that, but probably the more important question is that this person asks is, how will this impact the rest of the year's production as a country here? And that's $1 million question, quite frankly.
That's a Dr. Wolf question. I mean, what are the strategies that may be pursued? I mean, what are the ones that were actually followed to achieve that cutback? When you look at the milk production report, we saw that both cows and milk per cow were well down. So if you opened up a hole in your herd by selling cows, can you replace that quickly? And if you followed the strategy of taking your foot off the gas, as far as pushing cows too hard and milk production per cow dropped, can you get that back rapidly?
Well, I think those are the big questions, aren't they? That last milk production report, what was kind of surprising was how much milk per cow was down in some states, right? So, obviously I'm not a nutritionist, not even close. I'm married to one, but she would tell me to not talk about it, I suppose, because I don't know what I'm talking about. But, it's if you go to a high forage diet, so I haven't used the word, I'm the only one that hasn't said anecdotally yet. So anecdotally, I've talked to some producers that have, that did, move to more of a high forage diet, cut the energy use and bring milk per cow down that way. Can you go back to that lactation curve? It was always my sense that you can't, but I'm just the economist, so I should leave it to, maybe Corey needs to answer that. But, can we get the milk per cow back? But one thing that we do know from past experience is that $20 milk, if it starts showing up on milk checks at the feed prices we have now, U.S. dairy farmers will find a way to produce milk. They will definitely bring the milk back. Because cow numbers weren't down that big in most states, right? Yeah, a lot of it was milk per cow in some of the big dairy producing states. And that will be interesting to see as we move forward whether some of those milk cow numbers get revised, and where we're at there for the herd.
Well, and I think the other big question here then is the follow-up. You talk about what different individual producers have done. I mean, there's been some that have sold some cows and then this turned around so quick and their dairy plant said, hey, you can send us all the milk again. Others have kept those supply constraints in place. So it's very case by case basis here. But I think really, I heard Mark tell me this yesterday, that if anything begins with a 2, you should think about locking that in some way. That locking it in could be through DR, dairy revenue protection. This October, DMC, dairy margin coverage, will open up. You got hedging and puts and calls. Let's talk about, the question is, what measures should I as a dairy farmer do right now to take advantage or to remove some of the fluctuations in my milk price? How can I secure my milk market on the price end of it? So let's talk through that.
Well, Dr. Wolf, I'm going to let you take a big swing at this, but one thing that I think is probably, I would just say, don't worry about June. June is almost in the books, right? So it's not going to change too much from where futures markets prices say they are. Well, a few pennies up, a few pennies down, but don't spend your money on doing anything that nearby. The real question is those more out months. Now, of course, that's where it gets to be a little bit more expensive. But Chris, what do you suggest when you are teaching these to producers about what are the steps involved here?
Yeah, you know what? Historically, I would say if you're looking at put options, I would agree. June is, we're what, 10 days away from that one being in the books. It go up and down a little bit, but not much. We've pretty much built that price for the last 3 weeks. Normally in a normal time, I would say you don't want to be in the nearby 3 months. There's just not a lot going on, or usually in that time if we have kind of a normal pattern. But we are in such an unusual time here, and I think that there is the potential for big demand changes. Hopefully not, but there's the potential for that depending on what happens with government purchases, depending on what happens with the pandemic, depending on whether there's more stimulus provided, what happens when those unemployment benefits end at the end of July. Will those kind of be renewed? I think there's reason to believe that there will be some stimulus at least through the election. One would think because of politics, maybe, but we don't know. That I think, July is pretty close too, but that won't close until the end of the first week of August. But this is a situation where I think being only 1 or 2 or 3 months out actually might make some sense here if you have a good handle on your cost of production and these are numbers that can work for you, right? Normally, I would say historically the sweet spot is to be 9 to 15 months out. And by the way, there's quarter 2 of next year is 1630 for class 3, and quarter 1 is 1620 for class 3, and that's actually not so bad maybe historically, but but this is a situation given both the uncertainty on the supply and the demand side that I think being closer out where there's less time value, but maybe you can really and again, I'm thinking strictly in risk management terms here, right? When you take out the valleys, sometimes you're going to take out a peak. But if $22 works for you or $21 works for you, and you take some of that risk out, if it does go to 23, there might be a portion of your milk there that you missed on. But then this is another situation where put options might make some sense. But given the potential volatility behind it, there's that means the put options are going to be a little bit more expensive too because you're paying for it.
Yeah, and Chris, would it be fair to say that from the price hedging standpoint, I think one of the things I heard you almost say there was when you're talking about markets being further out is maybe protect your bottom side, but leave the top side option open in some of this too. But I don't want to put words in your mouth.
Yeah, no, I think, absolutely. If you can maintain some flexibility there and keep your upside, and it's going to cost you a little bit to keep the upside, right? So you got to look, especially if you're further out, there's a lot more upside out there in quarter 1 and quarter 2 of next year than there is in the, coming 3 months of this year, right? So I think there's more downside potential because the cheese prices that you mentioned earlier, Corey, and as Mark said, given where we are relative to world cheese prices, at some point there's can be some convergence there.
Yeah, and there are a few of those options for nearby things that are off the table. Dairy RP can only be implemented now for the 4th quarter of this year and on into 2021. If you want to do anything in, say, a July or August or September kind of milk price, then you're going to have to be looking at futures markets or some derivative from that. Whether it's options or maybe a fixed price forward contract with, your co-op or your handler who is in turn going to use futures markets. And I would just say, look at the cost of these things. So, for example, July and August, normally I agree with Corey that put a floor under it makes a lot of sense. Give it some upside potential. But at $22, how much more upside potential do you think it has? I want to look at either selling a futures contract or buying a put that may give me a little bit of upside potential, whichever one is least expensive for me. Probably going to be selling the futures contract, but work with your broker and find out which one works.
Corey, if I could just jump in with something a little bit different. Mark and Chris are intimately familiar with the farm record systems at Wisconsin, Michigan State, and New York. And we've all been struck at the incredible range you see every year, year after year, whether it's a good year or a bad year, between the highest performing farms and the lowest performing farms. And, it can be different farms in different years that are in those categories. And I think we're all expecting that huge range is only going to expand. And I think there's going to be some farms that are going to actually have some pretty serious questions about tax management coming towards the end of the year, which sounds a little bit crazy, but I'm pretty sure that's going to be true. And there's going to be other farms that are in desperate straits, more so than perhaps we've seen in other years. And I'm pretty sure there are different strategies depending where you are in that continuum of performance. And one of the things that has always made sense to me, which I could be the only one, but is you have to begin by figuring out what your long game is. You have to figure out, where is this business headed? Am I going to retire in 3 years? Am I looking to, grow because I'm going to be bringing in kids, blah, blah, blah. And that all makes a difference. You may be trying to think about, what do I need to do to be sure I have adequate liquidity when this market starts heading south? That's a little bit different strategy than saying, how can I prepare myself to affect my business plan for 2021 and 2022, which is a question that I think actually a lot of folks really need to be focusing on. I mean, yeah, you got to survive the current. That goes without saying. But for some, surviving the current isn't going to be all that difficult to do. But the real question is going to be, what's going to make me stronger going into the next year and getting ready for the year after that?
Let's do a little bit of speed round here. We got some questions that may need should be asked, but maybe a quick response. Will there be any changes to Dairy RP insurance program that make it monthly versus quarterly? And the viewer points out that one good month can wipe out 2 bad months, but that's more of a USDA program. Who wants to take that one?
There may be changes in a program, but I doubt that you're going to see it get down to less than a quarter. I'm just saying that this is my opinion purely. I have no particular inside information about this, but part of the reason for doing a quarter is that there is volatility month to month. And, we do have other tools like the futures markets that are capable of dealing with month to month volatility. This is more of a intermediate term strategy, I think, Dairy RP, which is also one of the reasons that you can't look at the nearby quarter. You can't invest in that. You have to go a little bit further out. So I doubt it, but maybe somebody has a different idea.
I'm with you. I doubt that change will happen given where it's run from what USDA agency. So a dairy farmer from the Northeast asked, order 1 PPD, producer price differential, is projected to be minus 439 in June because of the class 1 price surge. We talked a little bit about that, but why didn't we see a similar positive PPD for April, say plus 4 when class 3 crashed, but class 1 was still nearly $20? So a little bit of a timing issue, but a quick response on that one.
Well, I haven't looked at the arithmetic on that, but you got to keep in mind that we don't use the class 3 or the higher of to set the class 1 anymore. So when you've got a big spread between class 4 and class 3, you can get all fascinated about 3, but that's not what's driving the class 1 price. It's the average of the two. And I think if you look, it's the same story, whether you're in the Northeast or the upper Midwest or California. I think what you see is that the numbers that were driving the class 1 value from month to month were a little bit less exciting than what we were looking at on the class 3 side. And in fact, I would say when I look at those PPDs, and again, whether you're looking at the Northeast or the Mideast or the upper Midwest or some other direction, the PPDs were pretty small in the previous month. And in fact, if you look at the farther out price zones, which is a really big deal in the Northeast order, you got PPDs that were almost zero, and you got PPDs that the low price zone in the upper Midwest was actually a negative number.
So I think Chris can probably take this one. A question comes flat out. I meet with our farm accountant quarterly here, but does the CFAP this is the wrong one. Are the CFAP funds that dairy farmers getting taxable? And that's income. Chris?
I believe they are.
Mm-hmm.
And as far as I know, they are. Have you guys heard anything different? Usually government payments like that are ordinary income. And unless there has been some special allowance that I haven't heard about, yeah, there would be taxable ordinary income.
Another question come in, does the CFAP food purchases about them, can they last through the election? And I'm thinking they can, but there's only so much money allocated. Anyone want to dive in on that one?
They're budgeted to go through December. And the idea was that you would pace it out so that you would be able to do that. That's a little bit challenging to get it all that evenly spaced, but there's nothing special about the election that disrupts that. That's a budgeted program that USDA is going to implement according to the rules they were given.
They did front load the first month's purchases a little more strongly. And I guess that it's legitimate to say or ask the question, do we need much more stimulus in these nearby months as far as dairy is concerned right now? But I do think it's important to remember that these are dual goal programs. So it's not just about helping dairy farmers. It's also about helping feed food insecure U.S. population right now.
This was the first question that came in, and we talked about it a little bit yesterday, and I've gotten 3 other people have asked it. Replacement prices are still low. Do you see them staying there, or will they climb? When USDA collects that information, it's slow coming in, but I can tell you a lot of states, you weren't able to hold auctions. So it was one buyer to seller trade here. But that question really, again, replacement prices, is whether dairy farmers believe this is a long-term price or not. And I'm seeing a lot of trepidation out there. I haven't seen a lot of movement on replacement prices, but we're going to throw that word out anecdotal because it's really ears to the ground, boots to the ground. Anyone want to comment on that?
I think it depends a little bit on what strategy did you pursue if you reduced milk production on your farm. So if you pursued culling animals out of your herd or early dry off or early retirement for some of the animals, then maybe purchasing animals is going to be a stronger urge. If you pursued, making a less energy dense ration, then maybe you don't really want or need a lot more cows right now. You're going to focus on how do I get the cows I have back up to speed. So I haven't looked at it honestly, and I probably should have. Maybe Chris, it sounds like you did, but could we characterize by the regions of the country where we had more milk taken out by production per cow as opposed to culling animals?
Yeah, I think well, at least in this neck of the woods, it seems like some cows moved around because there was some base purchase that went with the herds and stuff, and so there was some of that moving around. So that might have quenched some of the thirst for moving some of that young stock. And then I also think, Mark, you're exactly right. It's kind of a little bit of a wait and see. We don't know how long. I mean, you saw in the one poll question, hold the line, because we don't know that this is going to last. And frankly, after the last 5 years, some of these guys might think it's a little bit better to build up some liquidity reserves than it is to put it into the young stock. But it would be interesting to see kind of how far that heifer price lags the milk price here.
Each week, this week we got a question here about whole milk and its impact on milk prices and the current situation. Now, if you want to talk whole milk here for the audience, first you got to break down what sales are in the class 1 beverage market, 2, 3 cheese, and 4 butter powder. So probably to sparse this question out a little bit here is what percentage is fluid sales, and whole milk is up, but in the United States we're using almost all the cream we make. So I'll read the question exactly as it was asked. What influence does the sale of whole milk have on the current situation?
That sounds like a Dr. Novakovic question.
Yeah, it increases the price of milk fat and it suppresses the price of skim solids. That's just basic economics. And because you have to recognize you can't make more milk fat without also making more skim solids, and you got to have some place to put it. Mm-hmm. And so we end up just selling more cheap powder to somebody in Asia.
So they're really tied together here, and I think people need to remember that. I think we got 4 questions. Well, we got one more here before we go to this kind of final one that we're going to meld together. How will the negative PPD, again, producer price differential, impact the pay price if a producer is using hedging strategies? So they're trying to factor in what that all looks like when you're working on that. So I'll repeat the question one more time because it's complicated. How will the negative PPD impact the pay price if a producer uses hedging strategies?
Well, I guess it matters as to what it was that you had hedged. Remember, the PPD is going to be tied most directly to a class 3 price because we're paying out for components in most orders, not all orders, but most orders on the value of class 3 components first. And then whatever is left over in the pool is distributed, via volume. If you've hedged with class 3 and you have a high class 3 utilization in your area, then you don't have very much basis risk out here because you're largely covering that with your hedging and future strategies. If you're in an area that typically has much bigger PPDs, Northeast is a very good example, or even the Southeast, to some extent, your basis may be more at risk.
So I'm gonna read these 2 final questions directly as our audience members sent them in, and then I'm gonna kind of knit them together because I think there's some good thoughts in there. And it's really, again, the pulse of the dairy farmers at this point. As you weigh the factors affecting milk price in the second half of 2020, how much weight does milk production carry? In other words, don't we, as farmers, have a large say in what price will be what the milk price will be if we show some production constraint? And does production restraint outweigh export prices, consumer sentiment, and so forth? And the other one is when Andy stated that with $20 milk and decent feed costs right now, farmers will be ramping up production. However, does he think increase in production will flood the market or lead to a surplus in supply again? So knitting those together, what about the urge to make more milk? In our dress rehearsal yesterday, we brought up the plea from National Milk Producers Federation CEO Jim Mulhern. The last thing we need is more milk. Let's talk about the second half of the situation with those last 2 questions from our audience. The milk supply will play an incredible role in this.
When I started out, I mentioned the poll and that most of the 2/3 of the respondents picked one of the demand questions. And, if I had to answer that question, I probably would have picked the supply answer. I would have done it believing that the other 2 answers are really important. And so, kind of the 1/3 sort of answer is appealing. But if I had to pick one, I'd pick the supply side. Because I think actually at the end of the day, changes in production, whether they're a little higher than trend or a little lower than trend, just seem to me to have a lot more potent impact on prices. And of course, producers want higher prices. And if we could restrain that growth, and I'm not talking about putting it in reverse, but just restrain it a little bit, I think it can have a potent effect on price. Now, if you follow that logic, all the way to its extreme, you're going to have one Jersey and Clark County that's making $1 million a hundredweight because that's the only one left in the United States of America. So there's got to be some point where you've got a better balance. But that example aside, I think our ability to not get carried away with production is going to be a lot more potent in maintaining higher level prices.
Yeah, and we all want to do the thing that would help us keep milk prices up a little bit. And so for the most part, we can begin to link arms and sing Kumbaya and let's not get carried away with milk production right now, right? But if there are roughly 37,000 dairy farmers in the country, and 36,999 decide that they aren't going to raise their milk production, I want to be that one that does, because I want to sell just as much milk as I can at these higher prices. And after all, what difference does that make to the margin, right? And that's when it begins to erode and fall apart. It really needs to be a coordinated effort if you're going to try to do that, in my opinion.
Well, and that's kind of maybe, Mark, where some of the co-op base programs come in, right? Because some of them, they're still on the books, right? So, or at least everywhere that I've seen, they're on the books. A couple of them have rolled it back a bit and said, instead of being down 6% milk production, you can be down 4% before you run into any overbase issues. And some of them have said temporarily, we're not going to be having extra charges or deductions for that overbase, but they're still there, right? And I think that was part of the co-ops and the processors in some of the locations recognizing that they wanted a little more coordination in the supply chain and maybe a little more discipline, and maybe that makes a difference this time.
Well, I'd like to invite everybody to our Thursday, July 9th program 2020. Dairy remains a powerhouse. We're really going to look into the retail side, in the restaurant side, and supply chain. So that's a special Thursday program. We'll send alerts out if you're already signed up to Dairy Livestream. Andy, Chris, Mark, and I worked really hard to get some special guests there. We'll tell you more about that in programming information that leads up. So again, I want to thank everyone for joining us today for our Hordes Dairyman live stream episode. Andy, Mark, and Chris, we thank you for your insight, and everyone have a great day. Take care.
Thanks.